Hello, Tom Hegna here with my 2019 economic commentary. It's already 2019. Normally I do my economic commentary in November or December, but this was no normal year. We had a lot of things happening. December was the worst December in the market in 60 or 70 years. Now, the market finished the year on an uptrend after it had fallen significantly, but then China announced slowdown in their economy, and then last night, Apple announced that their earnings are not going to be what's expected, and so the market today was down again. Look, I don't ever predict the stock market. That's not what this economic commentary is about. I do predict interest rates, and I can tell you a few things about the economy. Now, in the past, if you go back and you Google Tom Hegna economic commentary, you can see that from 2012, I have been consistent. One of the only economists in the world has been consistent in saying interest rates are not going up. I've been saying that. I'm saying it again this year. Now, let me tell you what's the same, and let me tell you what's different. Now, what's the same are the three things, big themes I've been talking about for the last 6 years: debt, deleveraging, and demographics. Those have not changed. I'm not going to get into them. You can watch the past economic commentaries, but those are three major reasons why interest rates are not going up. In fact, the debt is so significant that I would say there is a cap on interest rates in this country. Let me try to prove it to you. Let's just say interest rates went up to 5%. They won't, but let's just say they did. We are now at 21, almost $22 trillion in debt. At 5% interest, that would be over $1 trillion every year just in interest. Well, our entire federal budget is a little over $4 trillion. So basically 25% of our budget would go to pay for interest. If the debt goes up to be $30 trillion at 5% interest, it's going to be $1.5 trillion of interest. Well, our government can't handle that. We would have to do one of two things. We would have to slash government programs, slash military, slash Social Security, slash Medicare, slash Medicaid. If that was not politically feasible, they would have to raise taxes significantly. Either one of those things will cause the economy to literally crash or go into a recession or probably a depression. Well, what happens to interest rates in a recession or a depression? They go down. So what I'm telling you is, for sure, interest rates cannot get to 5%. I don't know if they can get to 4% or 3%. I don't know where the top is. But I'm telling you, because of this debt, there is a cap on interest rates. Now, let me tell you a little story. Let's subtract some numbers off of the debt. Okay, we raised about $3.3 trillion in revenue for taxes last year. Let's just say that we break the numbers down and say that's a person who makes $330,000 a year. Well, our debt is at $21 to $22 trillion. So let's say that person making $330,000 was going to buy a $2.1 or $2.2 million house. Well, you could probably do it on $330,000. You could probably buy a $2.1, $2.2 million house, but you'd be close to the edge, right? But that's not the whole story. The whole story is that our country has $150 to $200 trillion of unfunded obligations for Social Security, for Medicare, for Medicaid. Well, that would be like saying, okay, you're making $330,000, you've got a $2.2 million mortgage, but you've also got $15 to $20 million of outstanding promises. Well, somebody who's making $330,000 can't pay for a $2.2 million mortgage plus the 15 or 20 million. That's the situation our country is in, okay? So another thing is, this last year we filmed The Power of Zero. And if you've not seen the movie The Power of Zero, I would encourage you to Google it. You can literally rent a movie theater, invite your clients in, and many experts from across the country are in this movie. And one of the things that really struck me was one of the speakers was talking about the fiscal gap. Okay, we talk about the debt, we talk about the deficit. This was talking about the fiscal gap. I don't have time to get into it, but I would encourage you to Google fiscal gap, because that's the scary part of our whole financial situation. So we've got debt, we've got deleveraging. That means spending's going to have to get cut. Taxes are going to have to go up, which will strangle the economy. That's still out there. Demographics, those 78 million baby boomers heading into retirement, they're going to be selling their big homes, buying smaller homes. They're going to be cutting their spending. Many of them haven't saved enough money. Old people don't buy anything. So none of those things have changed. But let me tell you what has changed. If you think about it, back when Ben Bernanke was the Fed chairman, and the economy crashed in 2008, 2009, what did he do? He did two things. Number one, he cut interest rates basically down to zero. And number two, he started printing money. Now, he didn't really print money. It was called quantitative easing. Okay? So what the government did was they bought government bonds. They injected liquidity into the market to the tune of about $4.2 trillion. We've never seen anything like it. Well, whether you agree with it or not agree with it, you got to say it kind of worked, right? Because the economy picked back up. The stock market went up for what, 6, 7, 8 years in a row? Well, guess what? Now that's not QE anymore. Now it's QT. What does QT? Quantitative tightening. And what that means is now the Federal Reserve has raised interest rates for 6 times in a row. Now you just said, Tom, interest rates are not going up, but you just said the Fed raised interest rates 6 times. It doesn't make sense. Well, let me try to explain it. The Fed does not set interest rates, okay? The Fed does not set the normal interest rates. The Fed sets the overnight bank lending rate. That affects basically 0% of your clients. Now, in normal times, when the Federal Reserve raises 25 basis points, the 2-year would go up about 25, the 10-year would go up about 25, and the 30-year bond would go up about 25 basis points. That's how it works in normal times. That's not how it works anymore. The Federal Reserve has raised interest rates 6 times. What's happened to the 2-year, the 10-year, and the 30-year? They've basically stayed flat or even now gone down a little. At the time I'm recording this, the 30-year government bond is below 3%. What is that telling you? The market sets the interest rates. The Fed does not set the interest rates. The market is telling the Fed to go pound sand, basically, okay? And what the market is seeing is low interest rates as far as their eyeballs can see too. I've been saying for 6 years, interest rates are not going up. They're going to stay low as far as I can see. And that's what the market is telling you today. When a 30-year government bond is below 3%, do not expect interest rates to go up for a very, very, very long time. Okay? Not only that, but part of the tightening is they're now not printing money anymore. They're not buying bonds. In fact, they're letting those bonds roll off their balance sheet. So as the bonds mature, they're not buying anymore to the tune of $50 billion a month. So not only have we had 6 rate increases that slows the economy down, okay, and takes the heat off of everything, but now instead of printing money, we're pulling liquidity out of the market. Well, that's what's causing all of this volatility, okay? And I did my #1 LinkedIn post about 3 weeks ago, and all I said is what most people don't understand about the market is they've been taught their entire lives that the market goes up and down, but over time it always goes up. Well, that's fine if you're in your 20s and 30s and you're saving for retirement and you can close your eyes and just wake up when you're 60 and everything's fine. But that doesn't work for people in their 50s, their 60s, and their 70s who are in retirement or close to retirement who are going to be decumulating assets. Look, this has everything to do with sequence of returns risk. Now, most people don't understand sequence of returns risk. See, sequence of returns risk is why the stock market has averaged 12% a year since 1924. But if you're retired and you have your money in a diversified portfolio, you can't take out 12% a year. You can't take out 10% a year. You can't take out 8% a year. You can't take out 6% a year. You can't even take out 4% a year. You know what Morningstar says the safe rate is? 2.8% per year. That's all you can take out of a diversified portfolio. Now, most people don't understand that. If the market's average 12, how come I can only take out 2.8? And it has to do with, it doesn't matter what the average returns of the market is. It matters what the sequence of returns. See, if you retire and the first 3 years of your retirement, the market goes down, 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 and you're pulling money out of a portfolio, well, guess what? As the market goes down, 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 you have to keep pulling out more and more and more. And then when the market goes back up, guess what? None of that can grow back. And then the market goes down again at some point and you're taking out more and more and more, and none of that money can grow back. That's what the sequence of returns is. People don't understand that. It also doesn't explain investor behavior. See, I don't care how seasoned an investor you are, I will tell you every single person has a point of pain that if the market falls far enough, they will pick up the phone and they will say, "Get me out." Now, when they say "get me out," they've lost money on the way down and they're not getting back in right away, and they're going to lose money when it goes back up. And so for these reasons, you should not have a bunch of money in equities when you're in your 50s, 60s, and 70s. Now, I'm not saying have no money in equities. I'm not against equities. But what all the research shows from all the PhDs that I've studied who've studied retirement say you should at least cover your basic living expenses in retirement with guaranteed lifetime income. Now, there are three sources of guaranteed lifetime income: Social Security, pension, and income annuities. And so if you have enough Social Security and pension, maybe you don't need an annuity, but most people do. And the simplest and easiest way for the average person to retire happy and successful is if you're normally in a 60% stock and 40% bond portfolio, I'm here to tell you that will not get you through retirement. I'm here to tell you it will not. And one of the most simple ways to do it is just remove some or all of the bonds and replace them with guaranteed lifetime income from a lifetime income annuity. Now, this is backed by PhDs all over the world who've studied retirement. I'm not making this up. This isn't my opinion. I've written 5 books on retirement. All of my books are based in math and science. You can Google me, you can research it. But what I'm telling you is you need to have some guaranteed income. And if you have that guaranteed income, you can actually weather the storms of the market. That if the market goes up or down, it won't affect your day-to-day life. And that's what I'm trying to get across. So there's quantitative tightening. The Fed has been raising rates. The Fed has been unprinting money, which is taking liquidity out of the market. And then you've got these tariffs that are out there. So you've got all of these things going on at the same time, right? So what is the solution? If you're in your 20s and 30s, I would tell you, close your eyes, keep investing. You'll be fine over the next 20 or 30 years. If you're in your 50s, 60s, or 70s, you better wake up, okay? This is not a time to have a bunch of your money naked in the stock market. You see, the riskiest time for you to lose money in the market is right before or right after retirement. Because if you lose money in that box, it can devastate your entire retirement. So what do I see going forward for the economy? It's pretty simple. Interest rates aren't going up. I don't care what the Fed does. I don't care if they raise. I don't care if they cut. I'm on the record saying the 10-year bond will go negative before it ever hits 4%. And you can hold me accountable to that. The 10-year U.S. government bond will go negative before it ever hits 4%. Look, there are still trillions of dollars of government bonds around the world paying negative interest rates. Do you even know what negative interest rates are? It means you don't get paid interest. You have to pay the bank interest to hold your money. You have to pay the government interest to hold your money. And so when economies get really bad, when things slow down, when the stock market crashes, interest rates cannot just stop at 0. They can go negative. And I likely think they will at some point. Now, everything in the U.S. looks pretty good right now. But the problem is, around the world, things are starting to slow down. And you're going to start seeing it starting to slow down in America as well. Now, if the Federal Reserve would start cutting rates, if they would start printing again, I'm not saying we can't see the market go back up. I think at some point, of course it will. But for now, you got to hunker down. Interest rates are going to stay low as far as I can see. And it's going to be an interesting 2019. All right, let's just put it that way.